Okay, so today's we're going to be reviewing again. Now, this exam's only going to test you from chapters 2 through 11. So we're going to skip over chapter 1 just because this is basic information, right? The more content that I really want to test you on is more for chapter 2 and so on and so forth, right? So I will be testing you on things like knowing what accounts are, how to use their account balances, and etc., etc. Okay? So as far as that, this whole entire review, um, you will be asked things that were from the previous exam. Okay, so making sure that you know your account balances and know between the temporary accounts, because I will give you that same chart. But for the first 5 questions, it's going to be asking you what this account is, what's the determine the account type, category, and normal balance. Okay, so you do need to know this section for sure because I will be testing you on that section. Okay. For chapter 3, I don't think there's anything really for chapter 3 except for journalizing, which again, majority of the exam in this case is actually going to be more calculations. So, and there's going to be a few journalizing. Okay. Yes, you do need to know the accounting cycle. I will be asking you an accounting cycle question as well as a couple questions that are in regards to GAAP, making sure that you know the definition and know how to apply the definition. So I can give you an example of like a historical cost. I could give you an example of that one. And you need to be able to determine that this is historical cost. Okay. For chapter 5, yes, I will have a periodic question in the exam. Okay. Whether it is LIFO, FIFO, or weighted average, I do have one of these on there. Okay. But of course, the majority of this class, right, since I want to say I heavily weight the newer material for the second exam. So you do definitely need to know chapter 7 and chapter 8. So learning how to do perpetual inventory more so than periodic. So yes, there will be a lower cost of market example. So make sure you do practice this. We do have an example in the study guide. Okay. But like I said, like I will be testing you more so for the more newer chapters, okay? So especially for chapter 7 and 8, I will have 2 inventory worksheets. So you have to do perpetual inventory and be able to journalize it and tell the difference between the two, okay? And then chapter 9, I only need you to know how to establish and how to replenish. Okay, a petty cash drawer. For chapter 10, of course, since chapter 10 had the most calculations, you do need to know the difference between the allowance and, of course, the bad debt expense, like when to use it. And you need to know how to journalize it. But in this case, I will be testing you more so on doing the bad debt expense and determining the amount that you need to either debit or credit. Okay. Then, of course, there will be a simple interest question on there. Okay. Not compounding, because I can't assume that everyone has like a nice fancy calculator or an Excel spreadsheet or know how to use it. So there will be no calculations in regards to compound interest. Okay, but for the future, if you do end up going into your career, you do need to know that at least to help you know the basics of how a loan or credit card works. Okay. I will be testing you on do's and ifs, so bank reconciliation. Okay. And chapter 11, I will be testing you on all three methods. So determining units of production, straight line, and double declining. Oops. So no amortization, just because amortization is exactly the same as straight line. So yeah, so making sure that you know the difference between the three different methods, okay? All right. So again, we're just going to go over the first couple chapters here in the study guide, and then we will stop for the day, and then we will continue on finishing the rest of the study guide tomorrow. All right, and then we can go ahead and go off early for the Thanksgiving break. Okay. So once again, the exams question's not gonna ask like this, but it's gonna be where I give you a single table, and it's gonna give you the same formatting where I need you to do the account type, category, and the normal balance, and I'll give you multiple choice. So everything is gonna be multiple choice. There's no free response in this exam, so you do have the 25% chance of getting it right. Okay. So make sure that you do study this. So again, you need to determine the type, category, and the normal balance. So let's go ahead and get started here. Okay. Number one, checking. What account type is checking?
Asset.
It's an asset, yes. What kind of asset?
Current.
It's 100% current asset, yes. And what kind of balance would it have?
Debit.
Yes, it would definitely have a debit balance. Oops. Okay. What about accounts payable?
It's a liability.
Good. What kind of liability?
Current.
Good. And what kind of balance would this have?
Credit.
Yes. Inventory? What about inventory?
Asset.
Yes, it's 100. Yes, it's good. That's right. It is an asset. Now, what kind of asset?
Current.
Mm-hmm. And what kind of balance would it normally have?
Debit.
Yes. All right. What about supplies expense?
Expense.
Mm-hmm. Right. We talked about most expenses will have the word expense at the end of it. Now, what kind of expense is this?
Operating.
Yes, it is operating expense, right? It's the means to operate for the business, okay? So, what kind of balance would this have?
Debit.
Yes. Okay, what about accumulated depreciation?
Would that be a liability or a asset? No, not an asset. Liability.
It is definitely not a liability, because where does accumulated depreciation come from?
Comes from our asset.
Okay.
Wait, what is it? I don't know this one.
Anybody else want to try?
Would it be expense? No.
It's definitely not an expense. So you were floating around. You said accumulated depreciation comes from an asset. Now, what kind of asset?
Fixed asset.
Fixed assets, right? So in this case, that's exactly correct. It is an asset and it is a fixed asset. But what makes this accumulated depreciation different?
It has a normal credit.
Yes. So what do we call this? We call these contra accounts, right? This is an example of a contra asset account, right? Because it derives from depreciation comes from fixed assets, right? So that's exactly what this. This right here decreases the value of your fixed asset, right? What about bad debt expense?
It would be a liability, or no, expense. My bad. I don't know what I meant to.
It's okay. Expense. Now, what kind of expense?
Just operating, right?
Mm-hmm. So in this case, when you calculate and figure out bad debt expense, right? And you have to expense it, so basically you have to take a loss. This is a loss during the operations of the current accounting period. So in this case, right, whether you do it monthly or whether you do it at the end of the year, depreciate in this case, bad debt expense, right? It's a lump sum of money that is uncollectible. So when you do claim it and take a loss on it, it's going to be for that current operating accounting period. Oops, sorry. All right, can you guys hear me?
Yeah.
Okay. Okay. So in this case, yes, that's correct. It's an operating expense. Now, what kind of balance would it normally have?
A debit.
Yes, it would have a debit balance. Okay. I have inventory here twice, so we'll skip that. What about unearned revenue?
Income.
Mm, it hasn't been earned yet.
Is it a liability?
What? Yes. This is the case where a customer has paid you in advance for services you haven't completed. Hence, it hasn't been earned yet. Unearned revenue. So in this case, yes, it is a liability. Now, what kind of liability would this be? Because now you owe the customer some service, right?
Would it be?
Yes, it would 100% be current because unless other stated otherwise, unless you're in a contractual agreement, I've never seen somebody, pay something in advance for a year or a year and a half later. Okay, but yes, most likely, unearned revenue is going to be definitely current because when you pay somebody to do service for you, usually it's going to be within a year. Okay, unless, like I said, unless it's a contractual agreement where you are scheduled to complete it within 5 years and get paid, incrementally, right? Every year you get paid or something, then yes, that will be an exception to this rule. But in this case, most cases, if you're selling a product or a service, you are up to at least 1 year, okay? Because most likely the value of, things change in 1 year. So if you do put something down for a year later, I mean, chances of actually going through is very least likely, okay? And what kind of normal balance would this have?
Credit.
Yes, because it's a liability. Excellent. Okay. What about accounts receivable? Good. What kind of asset?
Current?
Yes. It's definitely a current asset, right? Accounts receivable is when customers owe you money, right? So that's going to be at the top of the window because you can collect that money any given time. Now, what kind of balance would this have?
Debit?
Yes. Okay. What about furniture?
A asset.
Yes, it's an asset. Now, what kind of asset?
Fixed?
Correct, right? It falls in the category of property, plant, or equipment, right? This is part of the plant because it's everything inside the building. All right. Now, what kind of balance would furniture have?
Debit?
Mm-hmm. All right. Next one we have here is owner's withdrawal.
Owner's expense.
Owners. You're mixing two of them up here. Is
Under
it
operating? Owner's equity, sorry.
good? There you go. Owner's equity. So in this case, yes, it's an owner's equity. Now, in this case, what kind of category does owner's equity would this fall under?
None.
None. Excellent. Right? There's no categories under owner's equity. However, what is the normal balance?
Credit?
This is an
Debit.
owner's withdrawal. Yes. In this case, owner's withdrawal, does it increase or does it decrease equity?
Increase.
It would decrease because you're taking away money, right?
Oh, yeah.
You're not adding money to the pile, you're decreasing it. So in this case, in order to decrease equity, you do need to debit the account. Okay? We'll take a look at, well, all of these, we'll take a look at an example in the fictitious business. Okay? What about sales?
Income.
Yes, 100%, right? That's how you generate it, right? Income. Now, what kind of income?
Sales.
Sales, okay, which is going to be your main operating type of income, right? So whether it's sales, depending on what it says up there at the category or whatever I give you the options. If it's sales, it's sales. If it's operating, it's operating because it's going to be your main core of way that you generate income. So is it going to be a debit or is it going to be a credit balance?
Credit.
Good. Okay. Last couple three here. So next one is going to be cost of goods sold.
Income?
Expense.
It is an expense. Okay. So in this case, cost of goods sold, right? We calculate this to essentially get rid of our inventory, right? What is the cost that it takes us to sell the product? So again, when you think about expenses is going to be anything that costs you money or anything that you get rid of or to spend the necessaries that you need to spend for the business. So in this case, it is 100% an expense. Now, what kind of expense would this fall under?
Cost of goods sold.
That's correct. COGS. Yeah, COGS for short. Now, in this case, right, when we talk about operating and the difference between operating and COGS, right? Operating is anything that is outside that deals with just operating the business alone. While cost of goods sold is directly correlated to your sales as well as your inventory. So know that, okay? So this is us getting rid of our inventory because we sold it through our income. Okay? All right, and then what kind of balance would this have?
Debit.
Yes, good. Okay. What about depreciation expense?
Expense.
What kind of expense?
Operating.
Good. It is an operating expense, so what kind of balance would it have?
A debit.
Yes. Okay, so again, depreciation. When we reach the end of the accounting period, you need to adjust your fixed assets because they lose value over time because you're using the fixed asset. Okay, so yes, it's part of the cost of doing business because that's what it is. Okay. Last but not least, what about allowance for doubtful accounts?
Would it be an asset?
Yes, in this case, yes, it would be an asset. Now, what kind of asset?
Current.
Yes. Now, same thing here. Now, what's the normal balance of the allowance for doubtful accounts?
Credit.
Yes. Okay. Now, where does this account come from?
From bad or from account receivables.
Correct. Right. This is another example of a contra account, right? You when a potential customer, right, decides to no longer pay, you need to have a sub account, or in this case, a contra account, to pull this individual out from the actual other accounts receivable, okay, and place it in this placeholder because it's a potential bad debt. They might not ever pay, or they will pay. Okay? So in this case, you got to put it into allowance for doubtful accounts until they do pay. Okay? Until it comes to the point where you've held it in there for so long that at the end of the giving accounting year, or again, the accounting cycle, you can write it off as bad debt. Okay? Good. All right, so again, I will be testing you on 5 different accounts here, so make sure you do know this all, okay? All right, now we're diving into chapter 4, okay? Under the rules of GAAP, which rule states that when you establish a business, you must keep your personal and your business transactions separate?
C.
C, business or economic entity. That's correct. Okay. Number 5, if I purchase a machine for $500 in my books, I must record it at $500. Okay, even if I plan to sell it for $700. Which GAAP rule states this?
Historical costs.
One, yes, historical costs. Even if you plan to sell it or get rid of your asset, you have to record it at historical cost. And you only recognize the gain or loss when you dispose the asset. Okay, so yes, historical cost is correct. Number 6, okay, customer A purchases an item for $15.65 from your store on an account, and then a few days later, you receive a check for $15.65. You must properly record the sale and payment. Okay, so then which GAAP rule states this principle?
Would it be B?
Matching principle, yes, right? Because your expenses match your revenues. In this case, when you sell a product, right, you're receiving the exact amount. So again, yes, you are going to properly record the sale, right, and the payment. So in this case, yes, it is matching principal. Okay. Cash basis is when
A.
yes, in this case, reading all of them, right? It's not B and C, and it's definitely not B or C. So in this case, it is just A. So in this case, because cash basis, right? You only recognize revenues when cash is received, and you only recognize expenses when cash is readily available to spend, right? You must pay your vendors at time of service. Okay. All right. Which of the following is not a step in the accounting cycle?
D.
Making decisions based on your financial statements is definitely outside the realm of your accounting cycle, right? This is what accountants do, though. Either the accountants do it, or even your profit managers, or anybody that is in your company that's in a position, they will be analyzing and looking at those financial statements, okay, including the accountant, right? However, that is not part of the steps of the accounting cycle, because your job is just to close out the books as the accountant, right? So you produce the financial statements and you just close them out. Just so then afterwards, when you've done that, right, that's when you can go ahead and make executive decisions based on the findings that you have in your financial statements. Okay? So I'm going to be moving into chapter 5 territory here. So chapter 5, all right. What are the tracking methods used for inventory?
A.
Yes, periodic and perpetual. Okay. All right. What? Whoa. What are the costing methods used for inventory?
D.
Yeah, all of the above, right? Making sure you don't forget specific ID does exist. And also note that when we learned periodic and perpetual, we learned FIFO, LIFO, weighted average, and again, if it's perpetual, it's moving average, right? So in this case, yes, we learned all three different methods, costing methods per different tracking method. Okay, so in this case, we learned about 6 methods, and we just left some specific ID out. Okay. All right, number 11. Okay, when delivery charges are made on COD, what does that mean?
C.
Cash on delivery. Good. You do need to know that part too, because you may see it on the exam. Okay, everything's fair game. Number 12. Okay, what is the definition of periodic and perpetual?
A.
A, right? Periodic means every once in a while, right? Periodically. And then, of course, perpetual means constantly, right? You're constantly updating the inventory at all times. Okay. Number 13, okay? True or false at the end of the period under the periodic tracking method, Okay, a conversion entry is required, is needed.
False?
Under periodic inventory, right? A conversion entry is needed. So when we reach the end of the accounting period or whatever it is under periodic inventory, right? How do we know how many items we sold? When we journalize periodic inventory, what do we recognize it as? Okay. We recognize them as expenses, right? So at the end of the accounting period, how do I know how much inventory I have on hand?
Okay, so that is that what a conversion entry means?
Correct, because you're converting from the expense to inventory.
Okay, then yeah, that'd be true.
Okay. All right, so that here you go. Let's practice. Use the following information to answer the next two questions here. So here you go. So on June 1st, you purchase 100 toys costing $1 each with a freight costing 25. So June 1st, 100 at $1 with a freight of 25. So purchase price 100 plus 25 gives you a total cost of 125, and it's going to be for $1.25, right? Now in this case, when we use this type of tracking method, it is going to be periodic and it's LIFO. Okay? So then let's see what happened next. June 10th
Total
rolls
cost.
around. Yes.
Total cost
What?
125, not 1.25.
Okay. So then right here, June 10, you purchased 200 toys at $1.25 with the freight costing you 50. So you bought 200 toys at $1.25, which gives you how much?
250.
Okay, plus 50 makes it 300, which makes my cost per item to be
1.5.
$1.50. Good. And then let's see what happened next. Now we have June 12th. You sold 200 toys at $5 each. No sales tax. So what do you do with this?
You take out the 200 toys from the last batch with the 200 that is 125.
So then in this case, right? Which tracking method are we doing?
LIFO.
Tracking method. That's costing
Oh,
method.
periodic. Whoops. Yeah.
So we're doing periodic, right? When do we actually keep track of our sales?
At the end.
At the end. So in this case, do we need to care about what happened on June 12th?
Not yet.
Not yet, because in this case, we're only focused on what we purchased, and we wait till the very end to figure out how much we sold. So in this case, you don't need to do that. Okay, so in this case, then we skip over it. So then June 15 rolls around, and we end up purchasing 300 units. Okay, so June 15, 300 units at $1.50. Okay, so that should give you
450.
450. All right, plus freight cost of 75 should give you 525. So then what is my cost per item here?
175.
$1.75. Okay. And of course, the next one is another sale. And then last but not least, June 30th, you have a total of 150 toys left on hand. So in this case, now let's total up our sums here. We have a total of 600 units. Okay. What's my total purchase price?
800.
800 plus my freight of 150 equals a total of 950. Okay. So in this case, now we can go ahead, now that we know that we have our ending balance is 150, that means our assumption is we had 600, now we only have 150 left, so therefore we must have sold 450. This is now where you apply your LIFO. So in this case, if I'm doing LIFO, which batch of inventory am I going to sell first?
June 15th.
Yes, the June 15th. So in this case, 300 at $1.75, which we know to be $5.25. Okay, so that's already 300 that we got rid of. How much more do we need to sell?
150.
150, right? 150 at $1.50 gives you
So,
225.
okay. So then, right, that gives you a total of 450 units at a grand total cost of
750.
750. So therefore, if it's 750 here, right, and you had the total cost of 950, so your assumption is your ending balance is going to be 200. So let's take a look here. What is your total cost of your ending balance, ending inventory on hand?
B 200.
Yes, it's going to be 200, and then of course question that falls right behind it is going to be what is the total cost of your cost of goods sold? 750. Okay. So I can test you on all three methods. So here you go. They are all there. I guess so in this case they're all the same. So I'm gonna just copy and paste it over. Okay. But of course the calculations are just gonna be different. Okay. Okay, this time, right, your method is going to be periodic FIFO this time. So again, if I have 150 units left on hand, I must have sold 450. If I'm using FIFO to calculate this, right, which batch of inventory am I going to sell from first?
June 1st.
June 1st, right? 100 times $1.25 will give you 125. Okay. Which batch of inventory I'm going to sell next?
June 10th.
Right, 200 at $1.50, which we know to be a total of 300. Right? So that's right there, 300 units. So how many more do I need to sell? 150. Right? So 150 times $1.75, what do you get?
260.
262.50. So if you add all this up, that's 450 units. Now in this case, how much is this one? Let's going to be
687.50.
687.50. So in this case, 687.50, and this is going to be 262.50. So once again, what is the cost of your ending balance in your inventory? 262.50. Okay. What is the total cost of your cost of goods sold? 687.50. Okay. And of course, you have the same thing here, except this time we're going to be doing weighted average. Okay. All right. 450. Okay. Now, in this case, how do I figure out what my total average cost per item is going to be?
You add them all up and divide it by the number of items.
Good. So in this case, right, what's my total cost going to be? And then what's my total quantity?
Total.
600.
Yeah.
Mm-hmm. So in this case, what's my average cost per item?
$158. 3200.
Good. So then I can solve either or, whether it's my ending balance or my cost of goods sold, right? 450 times $1.583333. That gives me
689.99.
okay, recalculate that.
Oh wait. Oh, 712.49.
49 should
85.
85. So that rounds up to 50.
50.
Okay. So 712.50. So that means your remaining balance here is going to be 2 3 2. Let me see. What's 950 minus this? So 12. 50.
237.50.
237.50. Okay. So then right here, ending balance is going to be 237.50. Cost of goods sold 712.50. Okay. So again, please practice this. Okay. And then of course do the conversion entry. So in this case, how do I do my conversion entry for this exact problem here? So we're assuming it's June 30th. Okay. How should my journal look like if I'm going to be doing this exact conversion right here?
With wait. So you're gonna need What is it? What's the just inventory
In this case, yes, I just wrote just
and then
regular, I just think I put units. No, toys. They're toys. So we're going to recognize
okay.
inventory
Yeah, toys,
or toys. Okay.
and then cost of goods sold, purchase expense, rate expense, and toys again.
Okay, good. So cost of goods sold, purchase expense, freight expense. So in this case, there is no inventory because there's no beginning balance here. So in this case, you're going to plug in your numbers, right? Cost of goods sold, or in this case, ending inventory was $237.50. We got the cost of goods sold as $712.50, right? We have the purchase expense at $800, and we have the freight as $150. Okay, so they do match on both ends here. So yes, that's how you do the conversion entry. Make sure you know this one because I may ask you on the exam. Okay, here, question number 21 on June 17.
Nick, it was 800, and then what was the freight expense was 150. Was it?
Because let's see, right here. Total purchase price is 800 and the freight expense was 150.
Okay, thank you.
So again, I will actually be giving you the actual like real form. This is just a simplified one just because so we can do this together. But yes, you guys will be getting the actual form for this for both periodic and perpetual. Okay. Then this question asks here for number 21 on June 17, if you received 10 broken mugs and you request a full refund from the vendor, okay? What account will you be journalizing for the return for if you are using periodic inventory? So you're making you received 10 broken mugs and you're asking for a full refund. What account would you use under periodic inventory?
B.
B, credit, purchase, returns, and allowances. Yes. Okay. Yes. Because expenses usually are flowing one way. So you do need to create a contra account for this, which is purchase, returns, and allowances. Good. Number 22, okay. If terms are 5%, 15 to 30, what does this mean? Take a 5% discount if you pay within 15 days. If not, pay in full in 30. Yes. It doesn't mean that you pay now or pay later and take 5%. You have 30 days. If not, you will get fined 5%. No. This is an incentive. Okay. All right. Question number 23. What does net mean?
B.
B, take discount immediately. Yes. Remember net, right? Think about your paycheck, right? At the top, you have your gross, which is everything that you've earned. Net is going to be taking everything out, and that's what your net pay is, right? Or your net check is when you take all your deductions and take all your taxes. They're all calculated out from it. So in this case, yes, net means you're going to take the discount immediately. Okay. Chapter 6, okay, we have here, okay, a customer buys 10 shirts for $5 each. Sales tax is 8.25%. Total cash sales was for a total of $54.12, okay? The next day, that same customer, okay, wants to return 5 shirts because they were the wrong size, Okay, the customer demands a full refund for the 5 shirts. Okay, what should the journal entry look like? Okay, assume you are using periodic inventory. So what is the journal going to look like if you are returning something? If the customer is trying to return something for a full refund.
It's D.
D, sales returns allowances in cash. In this case, you're forgetting something.
The tax.
You're forgetting the tax. Correct, right? Because in this case, if a customer is returning something, you must give them back the tax if you charged it. So in this case, C would be the correct answer, yes.
Yeah, I just got confused because the sales tax, I was thinking it would go next to cash, but it wouldn't. It would go back.
Right, because we're not. So in this case, this is recording the return, not the actual purchase.
Okay.
All right, perfect. Okay. 25, okay. When there's a store-wide sales discount for 40% off, you can only take discounts off of what items?
The selling price.
Yes, the selling price. So in this case, yes, sales, the merchandising selling price, yes. You cannot take a discount on tax, right? That's illegal. You cannot take it. You cannot take a discount on shipping and handling because that's what the customer is paying to get the item, and none of above is obviously the wrong answer. Okay. All right, number 26. Okay, use the following table to answer the next question. So here is A, lower cost of market. Okay, at which price is lower, cost or market? So let's go ahead and determine what is the ceiling price going to be.
133.
So again, ceiling is going to be your 133, you said?
Yes.
Okay, so there's more than 133. That's just your cost of disposal. How do I solve for my ceiling price? Right? Ceiling is going to be the selling price minus cost of disposal.
Yeah, and cost of disposal, which is 917.
Good, right? You're going to take your $10.50 minus $1.33, which you said $9.17?
Yep.
Okay, perfect. $9.17. Oops, 17. Right? How do I solve for the floor?
Which is ceiling price minus the amount profit, which is 562.
Good, right? Is ceiling minus profit, which in this case, ceiling was $9.17, minus the amount of profit of $3.55. What did you say the answer was?
562.
562. 562. So in this case, now I need to compare the three numbers, right? To determine the market. Which in this case, I'm going to take my ceiling. Okay, ceiling of $9.17 My replacement is going to be $4.05. And of course, my floor is going to be $5.62. So in this case, which number is going to be falling to the middle? Which one's the lowest, which one's the highest, and which one just is floating in the middle?
The middle is the floor price.
Good. The floor of 562, right? That's definitely higher than 4 and 5 cents replacement cost. Okay? So then, last but not least, which one is lower? My original cost for $4.75 or my market cost that's $5.62?
Original.
Original cost is going to be less. Good. Okay. All right. Let me pause here for a second.